Coffee is not Starbucks' biggest business. Its stored value cards now hold close to $1.8 billion in customer cash, money that earns no interest and is never insured like a bank deposit. That is enough to rival the deposits of a small regional bank. Every reload adds another dollar to a private cash reserve most customers never think about, and few ever ask where that money actually goes. To understand how this happened, it helps to look at what a gift card actually is, legally and financially, not just what it feels like to hold one. When a customer walks into a Starbucks store and loads money onto a card, that money does not disappear into a general pile of coffee sales. It gets recorded in the company's accounting books as something called deferred revenue. In plain terms, Starbucks now owes the customer a coffee, not the other way around. The cash sits on the balance sheet as a liability, meaning it is treated the same way a loan or an unpaid bill would be treated. Here is the part most people never consider. This system is not new, and it is not unique to coffee. Airlines, gyms, and department stores have used similar prepaid models for decades. What makes Starbucks different is scale. Few companies have convinced so many customers to voluntarily preload money onto an account they cannot spend anywhere else. Think of it like handing a friend $20 and saying, "Keep this, and I will only ever spend it at your store." Your friend now holds real cash. You hold a promise. That promise can only be redeemed one way, at one company, on that company's terms. By the mid-2010s, this simple mechanic had grown into a serious financial position. Starbucks reported stored value liabilities of over $1 billion as early as 2016, according to its own annual filings. That number did not shrink. It climbed year after year as mobile ordering and the Starbucks Rewards program made reloading a card faster than reaching for a wallet. Here's the insight: that rewards paying attention this early. That growing balance is not idle. While it sits there, waiting to be spent on a future latte, it still belongs, in practical terms, to Starbucks. The company can use it, hold it, and count it as available cash, long before a single cup of coffee is poured. This is the foundation the rest of this story is built on, a foundation almost no customer ever sees printed on a receipt. None of this required Starbucks to break any law or hide anything from regulators. Stored value programs are disclosed openly in public filings filed with the United States Securities and Exchange Commission every year. The system is legal, transparent on paper, and almost invisible in practice. That contradiction is the real foundation of this story. A public company can hold nearly $2 billion of customer money disclosed in plain sight, and almost nobody reading a menu board ever thinks to ask the next question. So what does a company actually do with almost $2 billion of other people's money sitting quietly in its accounts as waiting to be spent? That question has a more complicated answer than most people expect, because not every dollar loaded onto a Starbucks card is ever spent at all. Every year, a portion of stored value balances simply goes unused. Cards get lost. Balances get forgotten. Small amounts sit untouched for years. Under standard accounting rules, Starbucks eventually recognizes this unused money as pure profit, a practice known in financial filings as breakage. In 2019 alone, Starbucks reported over $120 million in breakage revenue from company-operated stores. That is money customers paid for coffee they never received, converted directly into earnings. This changes the entire picture. It means the interest-free loan described earlier is not the full story. When a portion of that loan is never repaid at all, in the form of product, it stops behaving like a loan. It starts behaving like a gift the customer never intended to give. Now consider what this looked like at scale, growing year after year as the mobile app made reloading faster and more automatic than ever before. Financial writers began comparing this pattern to something much older than coffee retail, the concept of float, the same principle insurance companies have used for generations, collecting premiums long before paying out claims. Warren Buffett built much of Berkshire Hathaway's investment power this way, using float that grew from $16 million in 1967 to tens of billions of dollars decades later. Starbucks is not an insurance company, and it does not operate under insurance regulation, but the underlying mechanic is strikingly similar. Hold customer money, delay the obligation, let the balance grow. Here is the twist that reframes everything discussed so far. This was not an accidental byproduct of selling gift cards during the holidays. It became a deliberate strategy, deepened intentionally through the rewards program and the mobile app, which made piloting money faster, easier, and almost automatic for tens of millions of people. By the 2020s, that strategy had pushed Starbucks' stored value liability toward $2 billion, a figure that begins to rival the deposit base of an actual regional bank. Yet Starbucks holds no banking license. It answers to no federal banking regulator the way a bank does. It simply built something that functions like one, in plain sight, disclosed in footnotes almost nobody reads. Which raises the question this documentary was always building toward. If nearly $2 billion in customer money moves through a private company with no banking charter, no deposit insurance, and no central bank oversight, what exactly is protecting the people who put it there? The answer is almost nothing, and that is not a criminal secret. It is a legal category. Money loaded onto a Starbucks card is not a bank deposit. It is not insured by the Federal Deposit Insurance Corporation. It falls under state gift card and unclaimed property laws, not federal banking law. Starbucks never needed a banking license because in the eyes of regulators, a gift card was never treated as a bank account. That single legal distinction explains everything uncovered so far. It explains why the balance can grow into billions without triggering banking oversight. It explains why breakage counts as ordinary revenue instead of unclaimed deposits. And it explains why, if a company holding stored value ever collapsed financially, cardholders would stand in line as unsecured creditors, not protected depositors, the same position as any other vendor owed money. This is not a claim about Starbucks facing collapse. Starbucks remains a large, financially stable company. The point is structural, not predictive. The protection simply does not exist in the way most customers assume it does. Here is why this stayed hidden for so long. None of it was concealed. It sat in public filings with the Securities and Exchange Commission, disclosed every year in language written for accountants, not customers. The system did not need secrecy. It only needed distance between the fine print and the checkout counter. This is why the story matters beyond one coffee company. The same legal gap applies to every retailer running a stored value or loyalty program, from airlines to gyms to grocery chains. Millions of people, without realizing it, are financing companies interest-free, believing they are simply saving money for later. Understanding this changes how the next reload feels. It is no longer just convenience. It is a financial decision made without the protections people assume come standard. But knowing the mechanism raises a harder question. If this arrangement is legal, disclosed, and growing across the entire retail industry, who is actually winning from it? Who is quietly losing? And what happens next? As more of everyday spending moves into accounts like these, that question does not have one clean answer, because the effects spread out in different directions, depending on who you are in this system. Starbucks benefits first and most directly. The company gains low-cost working capital, steady breakage profit, and customers who visit more often because their money is already committed. Shareholders benefit indirectly through stronger cash flow and loyalty metrics that make the business look healthier on paper. Customers carry the other side of that trade. Anyone who lets a balance sit unused is quietly funding the company for free. Anyone who forgets a card entirely hands over that money completely. Neither outcome requires wrongdoing. Both simply reflect how the system was built to work. Once other retailers noticed how well this worked, the model spread. Airlines, gyms, grocery chains, and streaming platforms adopted similar stored value and prepaid systems, each one legal, each one disclosed, each one quietly building its own version of the same float. That is the systemic effect. What began as a convenient payment option became a common financial strategy across retail, one most customers still do not recognize as financial at all. It did not require new legislation. It simply used existing gift card law in a way lawmakers never fully anticipated at that scale. The long-term effect is larger than any single company, as more everyday spending moves into apps, wallets, and loyalty accounts as more consumer cash sits in accounts without deposit insurance, without federal oversight, and without interest. This is not a prediction of failure. It is a description of where protection quietly ends and personal risk begins. For the average person, this changes something practical. Every reload, every preloaded balance, every unused gift card becomes a small financial decision, not just a convenience. Given everything now understood about how this system works and how far it has spread, the real question becomes what someone should actually do with that knowledge going forward. The lesson is not that Starbucks did anything wrong. The lesson is that a gift card or an app balance is not simply money waiting for you. It is a loan you gave a company without interest, without insurance, and often without realizing you gave it a ball. The biggest mistake is treating these balances like a personal savings account, letting money sit unused for months while it earns nothing and protects nothing. That habit quietly costs people more than they think, one small reload at a time. The actionable shift is simple. Load only what you plan to spend soon, and treat every stored balance the same way you would treat cash handed to a stranger with good intentions, but no legal obligation to protect it. This single habit change protects real money without requiring anyone to boycott a brand or panic about a system that remains legal and disclosed. This same pattern now touches saving, spending, and everyday financial decisions far beyond one coffee company because dozens of industries quietly built the same model once they saw it work. Starbucks was never the only company doing this. Airlines built the exact same system around miles that expire quietly and cash values few travelers ever calculate. Billions of dollars sit in frequent flyer accounts right now, governed by rules most passengers have never read, and shaped by a financial strategy even less visible than a coffee card. Understanding that system reveals who really profits when your loyalty sits unused in the sky.